Thanks for tuning into the Portfolio Manager. I'm your host, Niraj Shah. We try and talk about what an ideal portfolio within the equity landscape or a bond landscape could look like. In today's case, we're making an exception. We're choosing a particular theme. It's a very wide theme, but we're choosing a particular theme that is manufacturing, and we'll try and understand from our guest, how does he believe an ideal manufacturing-led portfolio could look like, and why is it that manufacturing could be a multi-year theme. Shreyash Devalkar, who's the head of equity at Axis Mutual Fund, joins us right now on the show to talk about that. Great having you, Shreyash. Thanks so much for taking the time out. Just trying to understand about this particular fund that you guys launched and you garnered money for. The timing was interesting because it's not like manufacturing hasn't had a good run, but it's also not like the run has come to an end because the theme seems to be slightly longer term in nature.
Sure. So in your opening remark, you mentioned that, yes, the theme is not narrow. It is a wider theme. And that's where I would like to begin from. Because for that matter, any theme, if it is narrow, then obviously its shelf life. And the way you explained it, already 3 years or 2 years, stocks have done well. And what next for next 5-10 years or so. So the shelf life of any theme is more dependent on how wider is the theme and what all it encompasses. So when it comes to manufacturing as a sector or as a theme, and if we go by its constituent of its underlying benchmark, then the theme actually encompasses various elements of economy. It captures consumption part of economy through auto OEMs. It captures through consumer durables. It captures investment part of economy through, say, auto ancillary, capital goods, and it captures export part of economy via sectors like auto ancillary exports, chemical exports, capital goods exports, textile exports. So because it actually touches all the three aspects of GDP of country, which is consumption, investment, export, it is a wider theme. As such, and that's where it is expected to continue to for a long time.
Got it. Now, Shreyash, we know about you, of course, very well, fairly renowned, but this scheme is a new one. So would you tell us a bit about what this particular fund would entail as it tries to perform over the course of the next 1, 3, 5, 10 years?
Sure. So this theme, as I said, is about manufacturing. And generally, when we talk about manufacturing, the perception is that it is only about, say, investment part of economy. And that's where I first started with. The first key point here is it is not only restricted to one component of economy. It is about all consumption, investment, and export part of economy. And out of these parts, you must have noticed that some of the parts actually. So let's just start talking about first on the exports. So India's exports actually for last entire decade were flattish. And this year onwards, this decade onwards, you can talk about decades now. You have noticed that there is a uptick in exports definitely. Even the investment part of economy has started doing well. So this theme and these multiple segments of these subsegments of this theme are getting its due importance now, and it is getting reflected in the earning growth as well. If you just look at only the PAT growth of manufacturing segment, it is actually better than the consumption segments in last 2 to 3 years. So what we are noticing is that multiple segments having done well. In this theme is relatively broader in its aspect. If you want to see from various multiple years point of view, then one need to go sector by sector, and probably we can comment on that in the latter part.
Yeah, no, sure. And I'll come to that as well. But just trying to understand that when you think of a manufacturing portfolio right now, and typically when a house thinks of coming out with a thematic fund, the belief is that it will have an ability to perform much better than what a normal flexi cap or a multi-cap fund might do, right? So how strong is the tailwind for manufacturing to be able to perform, and for how long? I mean, do you reckon that this is something that has got legs for the next 3 to 5 years? And does it have a potential to give much higher double-digit returns as an aggregate over the course of the next 3 to 5 years?
Okay. So your question is very much valid in the sense that how one should position it in their own portfolio as an individual investor. In my opinion, this theme should be looked at as a complementary to a large cap oriented portfolio, any large cap oriented portfolio. The reason being, any large cap or probably some part of flexi cap funds as well, which are broadly large cap oriented. If you see any large cap indices, the bulk of large cap indices up to 60% or more is actually about consumption as a theme, and the representation of the non-consumption sector is less in any large cap or flexi cap portfolios which are large cap oriented. And that's where this theme is, I would call it as a more complementary to your large cap oriented theme. So since you started comparing it with the flexi cap or multi cap, I would rather position it as a complementary to the large cap oriented, and more because the large cap oriented schemes or large cap oriented benchmarks are more tilted towards consumption oriented theme. Now, when it comes to its representation, again, what you will notice that most of the manufacturing sector oriented stocks are in the mid and small cap, and some part in the large cap segment as well. So that way, again, it is a complementary to your large cap portfolio. So when we start looking at it, it's futuristic, and how we should think about India's GDP will grow from here on. So in last 10 years, say from FY12 to FY22, nominal GDP of India was around 1.8 trillion dollar then, and now it is around 3.2. Now from the year, it is expected actually, as per various estimates, to go up to 8 trillion in next 10 years. But when we are talking about such growth in future, the expectation of what different component of economy will shape up during this transition, that expectation, if one try to see, then what it comes out that manufacturing share of GDP, which was low for last decade, is expected to grow faster. So if the manufacturing sector shares in the GDP grows faster, then obviously its share in the profit pool, and accordingly it should get reflected in the market caps as well.
Got it. Now, Shreyash, my reason for comparing it, I mean, I was not strictly comparing, but typically I think that when you come out with, when an investor invests in a thematic fund, the idea is that the risk is that much higher, and therefore the return should be that much higher. So I was not strictly comparing it to mid caps and small caps. I mean, maybe your benchmarks are large caps, but I just use that as an example to say that the risk and the return in a thematic fund, no matter how safe the theme might be, would be higher than a diversified fund per se, and hence I'd put it out. But sure. Yeah, but here's my question, therefore, within the various facets of manufacturing, because it's such a wide bucket, right? What do you believe would have the highest potential for giving returns? I understand that you do not have a firm portfolio in place, but if you had to try and tell us, where is it that you as a fund manager believe would the highest bang for the buck be in let's say descending order, the 3 or 4 key manufacturing themes that you believe? We'll get into the why on the other side of the break, but can you just have, what are these themes?
See, in manufacturing is actually, it touches various aspects of the underlying sectors, the way we look at from the sector classification point of view. And when you look at from that point of view, you will notice that the largest sectors, and see the sectors which are large for a reason why they have become and gone to that level. And there are sectors which are emerging in this. So if I want to choose from these sectors, and then if we also go through the underlying Nifty India Manufacturing Index as a benchmark, then clearly what you will observe that the large sectors here in that benchmark are auto components, capital goods, healthcare, that is a pharmaceutical, and metal mining. After that, chemical is one of the largest. So you see a diverse nature of these businesses across subsegments. And you must have seen not only in last 2 years. So some sectors like say chemical has been doing well since 2016, right? 2015 chemical started doing well. Some of the sectors like healthcare has shown patchy performances. Well, capital goods have started doing well in last 2-3 years. In auto and auto component in auto OEMs, some segments like two-wheeler have done recently well. Four-wheelers, SUV has started doing well in last 4-5 years. So it's not about only one, because generally when we think about manufacturing, only one thing which comes out in mind is capital goods, but then it's much more than that. So these are the established large sectors. Then there are emerging smaller sectors, which can be the themes in the EMS industry. There are multiple such industries which are growing, the suppliers to that and the ancillaries to that. So there are multiple such industries are coming up. So one need to look at from both point of view, the established industries which are there with the experience level, which is already available in the industry for last 3-4 decades. That is one set of industry. And the other emerging, where the experience is emerging. So it is just 4-5 years old as such, and the promoters also don't have too much experience operating in that industry and taking it to bigger scale. So that is the second bucket. So I would more look at it and try to balance it among these two.
Interesting, but we'll talk about these as well, because while it may be a new bucket, the not a promise really, but the commentary that is coming in from some of these companies about what could happen to this sector 3, 5, 10 years out is very, very promising. So we'd love to understand how you think about it in detail. But stay on, Shreyash, so much more to talk about. We'll just take a very quick break. On the other side of the break, we'll try and delve deeper into some of the components of an ideal manufacturing portfolio. Stay tuned to the Portfolio Manager. Back with the portfolio manager on NDTV Profit in conversations with Shreyash Devalkar, head of equity at Axis Mutual Fund. Shreyash, in the first segment, you spoke about some of the components of an ideal manufacturing portfolio. I would like to probe some of these in more detail with you. Let's start with auto and auto ancillaries. Now, they've had a decent run, and there is a wide bucket out there to choose from. I would love to understand, when you think about autos, let's start with autos. How do you think about what should be a part of the portfolio? Because it's just too wide a bucket. I've not even come to auto ancillaries, just autos to start off with.
Yeah, sure. So when we start with auto obviously has multiple components in it. Even auto OEMs, it comprises of four-wheelers, two-wheelers, and then tractors and CV cycle, and most of them are not recycles don't obviously superimpose exactly, and their behavior is different. In that context, what you must have observed that it's not you can't paint everything with one brush. In this case, if you notice that in the four-wheeler, the SUV part of industry has done extremely well, while headline level of PV industry's growth, volume growth may not be superior, while the SUV part has done well. So one need to focus on the segments or sub-segments which are doing well, and one need to try to find out beneficiary of that. And that beneficiary may be through the OEM, or it may be through auto ancillary as well. It need not always be through OEM itself. So in two-wheelers, again, what we have observed is the cycle has improved recently, and their numbers are coming out to be good. So that segment has multiple options in your large caps, mid caps, through auto ancillaries, and so on. So that's where one part of, and then there is obviously CV cycle, which is to be played. And in CV cycle, we have seen that there are multiple, again, both auto and auto ancillary. So when we look at auto, the way I look at it is the way it is touching, the way I actually started explaining about this theme, how it touches all consumption, investment, and export part of economy. So auto OEMs touch the consumption part of economy, and there you can find your winners. Then auto ancillaries mostly, and some of the auto OEMs also, but mostly the auto ancillaries touches the export part of economy. And in that export part, what we have observed is because of multiple reasons. It may be because of the non-availability of labor, or it can be because of energy crisis in some part of the world. There are multiple reasons because of which there is a clear-cut demand for some of the auto ancillaries getting manufactured. Either it can be forged component, or casting, or it can be machine component as well. So there is a demand for that to be shifted to the countries like India. And here I'm not yet talking about China plus one as such, because actually in auto ancillary, not many segments are about China plus one. It is on its own, this industry has done very well, and there is a demand for such a shift to any emerging countries. So all in all, this and that's where that is one of the reasons why this segment, if you look at the underlying benchmark index, this is one of the large segment of the underlying benchmark.
Got it, Shreyash. What about rural hurting, and does that mean that it's better to stay clear of rural exposed auto names or auto OE or auto ancillaries as well? The tractor companies, maybe some two-wheeler companies.
So again, so if you look at tractors, since you use that as an example, so when the rural tractor has had a really good cycle for last multiple years. So, and during that time, some of the other segments of the market, like FMCG, who has a very high exposure to rural for growth, those segments have hurt. So some of these things have not really played out in sync when it comes to multiple sectors. So FMCG, definitely multiple companies and managements comment about slower growth because of rural. On the other hand, tractor growth has been good. Again, in some of these tractors also has gone into construction as an industry. So there are multiple themes which are into play in this. So just to bifurcate something based on rural, urban, and all, that becomes sometimes becomes too simplistic. One need to get down 2-3 levels below and try to find out what are the real triggers for it, and whether the demand is good for it or not. And when it comes to rural versus urban, there is also a segment which you actually talk about consumption. The consumption, there has been a K-shaped recovery, and in the upper part of K, lower part of K. The real estate has been doing well, which caters to the upper part of K, and SUVs also is actually the outcome of the same. So there is a different way to look at it. So whether it is rural or urban, but this is the different way to look at it, that the consumption patterns are different in different categories for different reasons.
Okay. One question on the EMS space as well. Newer sector getting formed. Will the company scale or no remains to be seen. But their arguments and their commentary is extremely constructive. So my question, Shreyash, is would you include these companies despite the fact, I mean, if you had to buy them afresh, right? In your case, you will have to, because the valuations are stretched. Or do you believe the earnings growth will make up for these stretched valuations?
So when it comes to, as I said, one need to take a portfolio approach in all these things. One is the industries which are established themselves, where both manpower and promoter has experience of 2 to 3 decades on their side. While there are some industries where definitely that experience is not there, or decades of experience is not there. And on the other hand, they are promising because there definitely is going to be some sort of first mover advantage. Because it may sound as if that, okay, just electronic manufacturing is one of the simplest tasks, but operationally it is not as simple as well. Because you must have heard about rejection rates, which when you start in a new industry, the rejection rates are very high. And one need to go through this learning curve in any industry. And so this EMS industries also will have to go through that learning curve. So the companies which will end up going through that learning curve faster, so that whenever in the next round of the scale up will be with those companies, because handling that kind of manpower with less rejection rate, etc., those things will be tested, and those skills will be tested in years to come. And the companies which will go through this path, this painful path, sooner, probably will be the winner of these things. So we need to keep all these things in mind. And one more important risk aspect of it definitely is that if you see large established EMS companies in the region, especially in the Southeast Asia, if you look at their financials, once they are established, they may not be very attractive also. So there are 2-3 things in play here. So some companies so what we try to do is try to find out companies first which can show that scalability. Second is if there is and how much is totally a dependence on subsidy or dependence on some sort of protection because of the duties. And whether the companies can break through these protections so that they become sustainable. So all these angles we tend to look at when we try to add anything of such thing in the portfolio. And definitely, as you're highlighting, valuation is the very important parameter which we need to keep in mind, and that's where all the more analysis is being done around this.
Great insights. Well, I would have loved to talk more, but we are out of time completely. But keep in mind that next time that we talk to Shreyash, we'll talk to him about healthcare chemicals as well, because that's something that he had said could be in focus too. But Shreyash, take a moment to thank you for joining in today and giving us your insights. Lovely talking to you.
Thank you very much.
And viewers, thanks for tuning into this leg of the Portfolio Manager.